So good afternoon, everyone. Can you hear me okay? Excellent, thank you. So it's very nice to be with everyone this afternoon. So nice to see so many friendly faces, and some of which are quite familiar as well, and you know who you are. As Diana just explained, my name's Ian Drew. I'm the Regional Head of Climate and Nature-Related Risks for HSBC in Asia. Very grateful for the opportunity to spend some time with you this afternoon on the last session in this conference today. And we're very grateful to ASIFMA for giving us the opportunity for considering natural capital financing and biodiversity. Now, many people have come to appreciate the urgency in addressing nature, given that there's no net zero without stopping nature loss and moving towards nature-positive outcomes. Now, this is an area that's gained increasing attention recently, particularly with intergovernmental agreements such as that coming out of the UN Biodiversity Conference, COP15 in Montreal last year, and similarly, as well as the signing of the UN High Seas Convention, a real major step forward in achieving those nature-positive outcomes. Now, there's much going on with private sector collaboration. For example, the work that's going on with the Task Force on Nature-Related Financial Disclosures, TNFD, which will lead to some recommendations for adoption later in the year. Now, I'm delighted to be joined here today by three speakers, bringing very diverse perspectives. So we have Christine Lowe here, sitting beside me, who is the Chief Development Strategist at the Institute of Environment here in Hong Kong. We're also joined on the video by Rahul Ghosh, Managing Director, Sustainability Finance at Moody's Investor Services. So Rahul, could you just raise a hand, please? And of course, we're joined as well by Mervyn Tang, Head of Sustainability Strategy for APAC at Schroders. Now, we'll have a few questions of the panel, and then we'll move to some questions from the floor. I do appreciate it's the last session of the day, and I do hope that we keep your attention, and I do hope you get the opportunity, though, to ask those questions at the end. So if I may, starting with Mervyn, how would you describe natural capital, and why is it important to an investor or to investors?
Thanks, Ian. It's definitely a term that has grown in usage exponentially over the past few years. So maybe it's easier to describe by starting with some context. So many of our economic activities are dependent on nature. So the use of land for agriculture, the use of water to produce semiconductors. Nature also provides social value beyond economic activities. So a forest would be bringing value by sequestering carbon, by operating as a floodplain, by being a habitat for different species. And so because of this value, we are increasingly viewing nature as capital, because this value can both be depleted and replenished over time, depending on how we manage it. So that's why we want to see it as capital. And as we have seen with nature assets like forests or stocks of fish, for example, our depletion of these assets may not actually be reflected in our economic decision-making because they're externalities, and it makes society as a whole worse off. So I think if we recognize the value of natural capital in our decisions, you may start seeing governments put in place taxes and restrictions on activities that damage that natural capital, or maybe even reward it with things like subsidies and supportive policies to help replenish it. And so from an investor's perspective, we need to understand the risks to business models as well as the opportunities that it creates if and when policymakers and other stakeholders act in a way that takes nature into account, as things that affect the financial profile can also affect, hence, the value of investments.
Excellent, Mervyn. And it's very interesting how you drew there two examples of what could be referred to as ecosystem services, forestry, and water, whether that's fresh water also. And certainly, at HSBC, we have identified those as key areas. So we have existing sustainability policies. We've had those policies for 20 years or so, and we continue to refine those as appropriate. Now, we've said that we'll be publishing a deforestation policy within 2023, and that, like our other policies, will be available publicly. So it just shows the attention that banks, including ourselves, are giving to it. And then your mention of water. I mean, we've been doing various assessments to understand our exposure, or more importantly, our customers' exposures to nature and nature-related risks. And the couple of studies undertaken for our global operations have both indicated the importance or the reliance of our customers on water, and similarly the credit risks that some of those industries may be exposed to. So I mean, really, I've picked up there, and I've started touching on the on risks. So I mean, Rahul, to what extent are natural capital risks shaping credit quality across sectors and across regions?
Yeah, thanks, Ian, and greetings from a rather grey and drizzly London. It's apologies from my side for not being there with you today. I'm from Moody's Investor Service, so maybe I'll talk about the credit side of things. And when it comes to credit, we really look at natural capital risks through two interrelated lenses. So Mervyn talked about dependency on ecosystem services before. That is a clear area that we look at. Clearly, if access to those ecosystem services were to change, that can have operational risks for companies. We also look at the impact that companies, or in fact governments or FIs, have on the natural systems in which they operate. And that can have credit effects, whether that's increased compliance costs because of activities, or reputational risks, in some instances legal risks as well. So we look at both the impact and dependency lens, and then we overlay on top of that other credit factors. So we'll look at diversification, and generally speaking, that is a credit strength, whether that's from a product or a geographical perspective. We will look at financial strength, which is essentially the adaptive capacity of an entity to address its impacts and dependencies. And then we'll look at the quality of governance as well. So that essentially determines the ultimate impact of these exposures on our credit ratings. So how do we go about dimensioning the overall influence on global credit? Well, we, in our analysis, have identified 9 sectors with around $1.9 trillion of Moody's rated debt that has either high or very high exposure to natural capital. And the trend is really interesting there. That's twice the debt exposure that we saw in 2020. It includes all extractive industries where clearly they may cause damage to natural systems. There may be material remediation costs. There may be consumer backlash issues as well. It also includes sectors that are dependent on ecosystem services. Think about protein and agriculture. We rate 50 large protein and agriculture companies globally. That's where the dependency issue is really important. Think about water availability and how critical that is for fruit growing, for palm oil to maintain production levels. And then when I think below the sectors and when we're thinking about differentiation, it really comes down to product and geographic differentiation, as I mentioned earlier. So while we see exposures across the whole mining universe that we look at, there are a few mining companies that we think have slightly lower exposure. Maybe they have a smaller operational footprint. I'm thinking about some of the small diamond mining companies that we look at, or perhaps they're more focused on service providing, so rental of equipment. On the flip side, oil and gas companies may have, particularly upstream, may have large abandonment liabilities. That means that they are more poorly positioned than their peers. So the bottom line here, Ian, is that natural capital is starting to move the dial on credit. And I think that's going to only increase going forward as we start to see some of the trends that Mervyn mentioned continue to deepen.
Thank you, Rahul. And this isn't a discussion we've had before, but something you said there just triggered a thought in my mind. You know, the context of impact and dependencies is something we've really seen come through our consideration of climate. The other thing within the climate is the understanding of physical risks versus transition risks. So put you on the spot a little bit here, but to what extent do you separate physical risks from transition risks in your assessments?
Absolutely, we do. And I know we'll talk about some of the disclosure frameworks earlier, but the idea of physical risks and transition risks is important. I think it's important in many instances, but to be brief, probably from a time horizon perspective. Physical risks, we know are there. They can have huge impacts, whether from a climate perspective, potentially from a nature perspective as well, but tend to be more slower moving. Transition risks, changes in regulation, changes in market preferences can happen very, very quickly and mean that an entity has to respond to changes in the regulatory and business environment in which they need to operate. And the final thing I'll say is there's clear interrelation between the two, and I think that's clear when we're talking about climate and nature, and I'm sure we'll talk about the nexus between the two during today's discussion.
So, thank you, Rahul. And actually, this goes on quite nicely, actually, Christine. I mean, so what would you see as the interplay between climate risk or climate and biodiversity?
Well, maybe I can put it like this. Mervyn talked about nature and seeing nature as a form of capital. Well, actually, everything that we have comes from nature. The Earth is a closed system, meaning everything we use and make comes from planet Earth, and everything we throw away, waste, if you can call it that, stays on planet Earth. So I think understanding the Earth system through science is really quite difficult. Measuring pollution is relatively easy, you could say, because we've now been doing it with laws and so on for about 50 years or so. But measuring nature and turning nature into capital in the way that the world has understood economies and financial system, right? What we're trying to do here is we're trying to take nature, which is hard to understand, right, and hard to measure, and we're trying to now fit it into our economy and our financial system. And actually what we're trying to say is we understand that climate change is very real, biodiversity, and if our ecosystems are not strong, then the climate risk will even be bigger. So that's why, as you said, in the last few years, we're seeing biodiversity. That's about nature. That's about the nature as we understand it. That's about ecosystems, that we now need to pay as much attention to biodiversity as to climate. So the two are coming together, but we are trying to fit the way our economy and finance work into this. That's why we're talking about climate data, biodiversity data, can we have more products? So, and what are we really trying to do? We're trying to get more money from investors to go to areas that are part of the transition. They're green or they're part of the transition. So all this discussion that we're having as to what we should do. Now, I go to lots of discussions in this sort of science engineering field. They don't understand any of the stuff that you're talking about. And what you are trying to say is, we want better data. You know, can someone measure better data, fit it into some system? And I think it's a positive thing, because finally we're asking these questions. We're asking how we can value nature. So I just want to say that we don't quite know how to do it yet. We're getting to the point where some of the uber brains around the world, like yourselves in the financial sector, are wanting to take the learning from science and engineering and climate and meteorology and biodiversity, ecosystems, and so on, and try and fit it into something that you can value and trade, right? So we're at the beginning. I'm actually quite positive that we're in this space finally, but it's going to be a long journey.
Understand. Thank you. So clearly, though, you mentioned there about bringing the need to bring investors in, and similarly, the challenges there you mentioned about data, etc. So there will be risks and there'll be opportunities for different stakeholders, and these really need to be carefully considered. And in some ways, those are extremely complicated when we're bridging different ecosystem services, as Mervyn, you mentioned earlier, forestry and water. So given the risks and opportunities related to natural capital, what are different stakeholders doing in response?
Absolutely. So for investors, I think it's worth thinking about this in kind of two lenses. Our fiduciary duty to kind of extract value from our investment process, and then there is that kind of moving that flow of capital towards preserving nature and biodiversity. So let's start with the first one. it will require, kind of Rahul said, with kind of what he talked about with credit risk and credit rating, embedding the assessment of these biodiversity risks and opportunities into our sustainability models, as well as our investment analysis, so that we can understand biodiversity in the context of many other risks, and be it social, governance, environment, that we have to consider, and kind of how it fits into our assessment of valuation, prospects of the company, and many other things. The second bit is what we can do as a shareholder, as an active owner, to engage companies on these issues, to drive them towards a more sustainable business model, because we can help support value creation through this engagement activity. Now, some of our clients want us to go beyond this, right? They don't just want us to integrate these concepts into our investment analysis from a risk return perspective. They want us to focus on nature as an objective. This is when that kind of dictating that flow of capital comes in. And this can come, I could say, in both the public markets and the private markets. So in the public markets, it could be funds that invest in companies most resilient to biodiversity risks, or those with the policies and processes that make them leaders when it comes to considering and managing natural capital. It could be business models that align to opportunities created from biodiversity. So we talked about water, for example. Maybe it's water sanitation technology that improves the supply of water. It can be technologies that increases the productivity of land and agriculture. There's a lot of things we can talk about when it comes to just like a public market options that are focused towards nature. I think what's interesting in the past few years is an interest from investors, institutional in particular, in directly investing in natural capital. For example, say buying forestry assets. And so there are many considerations here, both financial and sustainability focused. So if I am thinking about buying a forestry asset, historically, there will be cash flows that come from the production of timber. But how do I manage the forest in a way that would sustainably provide that timber, so I'm not just kind of having a short-term focus and basically burning out that cash flow very early? But if I change the way I manage that, what happens to the biodiversity of that forest that I'm managing? What happens to its potential as a floodplain? What happens to the potential for carbon sequestration? I think another interesting development in the market is the voluntary carbon offset market, where assets like forests can provide us another cash flow by producing carbon offsets. But then we have to start thinking about, okay, if we plant trees to maximize the production of these carbon offsets, what does it mean for all these biodiversity co-benefits? I think with this interest in these asset class, how to manage these properly, I think we're creating opportunities for investors directly investing in this natural capital.
Thank you, Mervyn. And I mean, and clearly, really good outline there of the position or the role that the investors will take. Rahul, what's the role of capital markets in financing nature positive investments, and to what extent do you see sort of sustainable bond issuance pick up in this area?
Yeah, I think there is really strong potential there. If I think about the sustainable debt capital markets, it's largely been, we talked about in the last panel, the growth and development, but it's largely been a climate change mitigation story. So even if we just look at last year, in the use of proceeds market, around 50% of all projects went to renewable energy, clean transportation, green buildings, so projects that are really focused on decarbonisation. When I look at use of proceeds for the sustainable management of natural resources or for conservation, terrestrial or aquatic conservation, we're talking around just 5% today. So why is this the case? We know that these are issues and they're interrelated issues, as Christine mentioned. It's really because fundamentally it's difficult to find bankable projects at scale for benchmark size bonds, particularly in the markets, emerging and frontier markets are the most vulnerable to these issues. So how does this all play out? I think in the short term, it's really the onus of public sector issuers, sovereigns and regional governments to get at the forefront of financing nature and biodiversity through the debt capital markets. Emerging, for governments, clearly nature is a key component of climate change strategies, NDCs. We've talked about the link between climate and nature. I do also think, and Ian, you mentioned this at the beginning, that governments will look to use thematic debt to reiterate commitments to global policies, such as the 30 by 30 pledge at the Kunming-Montreal Global Biodiversity Framework. We've seen some examples. So Egypt, for instance, we provided a second-party opinion on their sustainable finance framework just ahead of last year's COP. They've included certified sustainable fisheries, aquaculture management projects in their framework, also replenishment of watersheds, for instance, as well. Another trend I think that's worth watching is sovereign issuers incorporating KPIs and nature-related KPIs into their sustainability-linked bonds. We saw that with Uruguay last year, which includes a target to protect forests in their SLB as well. And then there's debt for nature swaps, which is probably a whole other panel. I think the missing element here, just to finish, Ian, is what about corporate issuers? How do we get them into this market? I think it's probably going to be a slower burn given some of the challenges I mentioned around financeability of projects. But as we start to see investors like Mervyn, engage with companies, as we start to see new disclosure frameworks, reporting directives, clearer policy targets, I do think we'll see over time more companies disclose nature-related targets and their implementation plans, and perhaps some of the more sort of innovative ones incorporate those targets into their debt capital market plan. So something to watch, I think, but probably over more of a 2 or 3 year time horizon.
Thanks, Rahul. I mean, it's quite interesting there. You picked up on the role of the public debt or the public debt markets, and also on a number of points there, the role that the public sector can play in facilitating that. So, Christine, I mean, what do you see to be the role of governments and other public bodies in supporting and developing this?
Right. Well, we talked about, or you mentioned earlier on the COP meetings and the biodiversity meetings. So from government's point of view, there are multilateral discussions. Multilateral discussions come with certain targets and timelines. Now, once government have agreed with each other that those are the timelines, and we have these ones on biodiversity now, land protection and so on, each government will have to go back home and regulate. How are they going to make it happen? Because they've promised the world that this is the way you're going. So all of them will end up regulating at home. Now, so when you're regulating, now I think they're bringing in also, their regulations are the normal kind of regulations that governments know how to do. Today, the financial sector are saying, well, actually to direct more money in, so for example, if you are a government and you want to reforest, maybe you can raise bonds, green bonds, to do that. Whereas before, a government might sort of say, well, can I afford to do that? If you're the private sector, if you own land, let's say if you're a forester, that is the traditional, everybody thinks, well, to diversify your risk, people are buying up forests. How you manage a forest, I think Mervyn explained a little bit about how you do it. But going into the future, I think forestry companies are also thinking about every aspect of their work and whether there is a net cap potential to it. So I think we are going to see maybe new products, if you can call it that. And in the interest of full disclosure, I sit on a sustainable forestry company's board in Australia. And the reason that I want to sit on a board, like for such a company, is to learn actually how you do it. Because we said earlier on that can we actually learn what people know today, for example, in forestry, and actually push it further into things like carbon credits, creating new products, into land management, because land management, forestry, and different types of natural capital products are all linked. But we didn't kind of look at it like that until today, because we understand we want to rebuild ecosystems. So that's my first point. And government doesn't quite know how to do that. They've asked the financial regulators to do it, and the financial regulators are actually relying on the private sector. So, ISSB and FSDC, I mean, all these acronyms that we've been talking about all today, these are all private sector led. And the leadership in these areas are generally individuals who've spent a long time, maybe 20, 30 years, thinking about these issues. And finally, governments and the financial sector is interested. So I do see there'll be an explosion of interest in this area. But the difficulty for us, again, is the credibility of the data. Do we know what we're measuring? Because measuring nature is really difficult. But all I'm saying is governments are not yet ready to regulate, which is why the private sector and very passionate and knowledgeable individuals are trying to do this.
Thank you. Now, I appreciate we've only got a little under 8 minutes left, so maybe I'll wrap up with just a couple more points. And then, Christine, thank you so much. You touched there on about some of the disclosure standards, et cetera, and what ISSB is trying to do. But, you know, we've already earlier mentioned the link between climate and natural capital. And climate is complicated and challenging, but I understand it's really been helped by some key sort of developments, such as the Greenhouse Gas Protocol and the TCFD, the Task Force for Climate-Related Financial Disclosures. But actually, if I could turn to Rahul, what value would you see in the forthcoming TNFD recommendations, and what would you see to be the challenges in their use?
Yeah, thanks. I think it could be a really huge development in this space. We've talked about the challenges around measurement and valuation. That's so important for any company that's looking to factor nature into strategic planning, investment decisions, or indeed for ourselves into credit analysis as well. So I think TNFD will provide a meaningful and consistent framework. I would, just as full disclosure, I've been privileged to be part of TNFD on behalf of Moody's. For the audience, look out for version 0.4, which is coming out in a couple of weeks, and the final recommendations are slated for September. I think there will be steady adoption of those disclosure recommendations, and I'll probably give you 3 or 4 reasons why, Ian. So firstly, the way it's been designed, there are clear synergies with TCFD in scope and structure. So there are comparable disclosures across each pillar, from some strategy through to metrics and targets, and an opportunity then for preparers of information to consolidate. I think TNFD has worked on some really useful guidance documents as well, not least what they call the LEAP approach, locate, evaluation, and assess and prepare, to help identify prioritized locations and report on those locations. TNFD has also taken a bit more of an agnostic view on the materiality question. Should it be single or double? They've essentially created a framework that allows the reporter to integrate and disclose their materiality preferences. And then the final point on the sort of why I think it will be adopted is they've also tried to link disclosure and metrics as much as possible to the global policy frameworks that you mentioned at the outset. But as you mentioned, there are challenges, and I'm a credit rating analyst. I'm generally glass half empty, so it would be I'll mention a few of them. Firstly, it's around metrics, right? The core metrics for climate and TCFD are essentially scope 1, 2, and 3 emissions. They have their challenges, but at least there is a sort of a single measure for climate. It clearly isn't as easy for nature. The core metrics that TNFD are looking at will touch on land, freshwater, ocean use change, pollution, resource use, but it's challenging. And that's for direct impact. Then you think about the sort of scope 3 concept for nature, upstream, downstream, financed exposure to nature. And I think that's going to take a bit longer. And that's a challenge for financial institutions, of course, who would tend to have more of a sort of scope 3 exposure. And then you have things like scenario analysis and transition plan guidance, which will take some time. But we have to start somewhere in, and there is a comply or explain philosophy in TNFD. So I think, we'll continue to see good adoption and continued iteration and improvement in the quality of those disclosures over time.
Thank you. And just for the purposes of full disclosure, HSBC has similarly been part of the TNFD process, and we have piloted an earlier version of the beta framework and learnt great lessons for us, and also we fed those lessons back to TNFD as well. Clearly, you've mentioned that, Rahul, about the benefit for the investors there, the investing community, and many parties, but the investing community as well. So, Mervyn, how would you say the investing community would wish to see these standards evolve?
I would say, I think with all these standards, you need to have realistic expectations of what they do to avoid being disappointed and recognize that it's something that has to evolve. And so I think if we're talking about TNFD, helping to standardize company disclosure in a way of a set of pillars like they have with TCFD, similar metrics, it allows for data to be much more comparable and helps investor with analysis. It's not going to be the silver bullet that some are looking for, in the sense it will stop you, it will suddenly tell you which activity is going to be nature positive, or how do I create a biodiversity fund that's not going to be accused of greenwashing. That's not what we're going to do, because nature is such a complex task. Just because we have some metrics, for example, just because a company has 100% RSPO certified forest doesn't mean that it doesn't have deforestation risk. Just because a company has a higher water withdrawal than another company, it doesn't necessarily mean that it's more exposed to water scarcity. It's going to be partly dependent on the pool of water it's drawing from and kind of how that might evolve with physical risk in the future. And so I think one of the things I think Rahul already mentioned, the locational focus of TNFD, I think that is leading to investment in much better mapping and understanding of location of data, which is going to, I think, not just help with the analysis of biodiversity and natural capital risk, but physical climate risk. And it's something that I think we're going to gradually build on, right? Like we better understand our physical asset base, better understand our customer base from a geographical perspective. And that's all going to help with analysis over time. And I think I think what I really want to see in how things evolve is that the ecosystem, in terms of data providers, standard setters, our own investment analytical processes, the bank's own credit analysis process, all of that will hopefully evolve to accommodate this kind of the TNFD analysis in a kind of better way.
Thank you so much, Mervyn. Now, I offered the floor the opportunity to ask questions, but unfortunately, I think we're going to be timed out, so I do apologise for that. But what I would say, I hope you found these different perspectives helpful. I personally think that this will be an area of tremendous focus, particularly in Asia, given the dependency of so many of the economies in Asia on natural capital and natural capital services. There was a report done a couple of years ago by PwC in conjunction with the World Economic Forum that really showed the dependencies of the Asian economies on that. And again, in terms of disclosure, our Chief Sustainability Officer, who was appointed last year, or 2020 actually, Celine Herware, was actually one of the co-authors of that report. And it's a cracking good read, and I'd strongly recommend it. So thank you very much, everyone, today. I hope you've enjoyed this session, and actually I hope you've enjoyed the whole day's events. Thank you.